This video is for educational purposes only and should not be considered financial advice. 3 strategies to trade the market maker model. In our previous video, we talked about how the market maker model is the best tool to know where you are in the price action. In this video, we will show you how to use this information to your advantage by giving you 3 strategies to trade the market maker model at the different levels. Quick review. As said before in the previous video, every move that price makes is a market maker model. The key to spotting them is knowing the true short-term and intermediate swing levels. After that, it's as easy as counting from 1 to 3. Here are the 3 types of price patterns, as outlined in the previous video. 3-level market maker model, 2-level ABCD pattern, and the 1-level Judas swing. Now on to the 3 strategies. These strategies have around a 90% win rate. To trade level 1, use an optimal trade entry. Look for level 1 to occur with a break of structure after a level 3 completion, which means price has retraced to the previous level 2. Wait for price to retrace to the 50% of the level 1 impulse. Then enter your trade. Place your stop loss beyond the level 1 impulse origin. Your target is a 2-to-1 reward to risk. For level 2, look for a fair value gap after the level 1 has been completed. Wait for price to retrace into the fair value gap and close outside of it. Then enter the trade. Your stop loss is beyond the level 2 impulse origin. Your target is 2-to-1 reward to risk. For level 3, look for a swing structure break after a level 2 completion. Wait for price to create that swing level and then wait for the 3rd candle to be violated. Enter the trade when the 3rd candle is violated and price is beyond candle 2. Your stop loss is beyond level 3 swing high or low. Again, your target is 2-to-1 reward to risk. Here's strategy 1. We wait for level 1 to be created, then a retracement back to 50% of the impulse. Your entry would be there. Your stop loss is at the beginning of the impulse origin, and then your target is 2-to-1. So here we have level 1 being created, then a break of structure, and a retracement back into the 50% level. Now this actually might have been a loss because this is the origin of level 1. However, if you're playing it safe, you can go beyond to the farthest swing level. But then level 2 occurs, price retraces back into this fair value gap, then closes outside of the fair value gap. That is your entry, with the stop loss behind the fair value gap. Then price moves to 2-to-1. At level 3, we see a swing level created with a candle to the left that is lower, candle to the right that is lower. Once this candle is broken right here, that is your entry. Price moves, we put our stop loss behind the swing level. Price gives you 2-to-1. In this example, again, level 1 is created with a break of structure. Then we see a retracement to 50%. You have your entry with a stop loss beyond the origin of level 1, and that is a 2-to-1 trade. At level 2, we have the break of structure, a retrace into 50% of this impulse, but there's no fair value gap. You may elect not to trade, or you can use this inverted fair value gap as your entry model. Once price closes outside of this inverted fair value gap, that could have been an entry with a stop loss behind the fair value gap. Price continues and gives you your 2-to-1. At level 3, we see price create a swing level, and once the 3rd candle is broken, you can enter. Put your stop loss beyond the swing high. This trade does not pan out. As we see in the next slide, this is a loser. You don't get your 2-to-1. But if you practice safe trade management, you can move your stop loss to break even once you hit your 1.5. And you do get 1.5. Again, level 1 is created. Price retraces to 50%. You get your entry and you get your 2-to-1. At level 2, a fair value gap is created. Price goes into that fair value gap, closes outside of it. You enter, put your stop loss beyond the fair value gap, and you get your 2-to-1. At level 3, price creates a swing high. Now you're waiting for this level to get traded through. And you can put a pending order to make sure that you get it. Price taps you in, continues to the downside, gives you your 2-to-1, and then it retraces. To recap, using these 3 strategies can help you take advantage of the clarity that the market maker model brings to reading price action. If you found this video helpful, please like and subscribe for more videos like these. Also, please leave a comment if you have any questions or if you have any other video suggestions. Thank you for watching.